right, guys, we are here again, and this is our last class period in regards to Chapter 4. So, after this lecture is test time, isn't it? Okay, the next test is after Chapters 3 and 4. We'll talk about that a little bit at the end, okay? But the first thing I want to do is I want to go to the PowerPoint, and I want to talk about a few things that I wanted you to read about. Okay, let me get up to where we're supposed to be. Okay, I want to talk about the classified balance sheet, and hopefully you read about this. But the balance sheet just groups the asset and liabilities into important subgroups, okay? Up until now, we've just kind of been throwing everything on there and then just making one big total, okay? The classified balance sheet puts them in important subgroups, and I'll talk about what those are. One of the main and most important subgroupings that we will have on the classified balance sheet is that in regards to current assets versus non-current assets, and current liabilities versus non-current liabilities. Okay? Now, at the bottom of this PowerPoint slide, it says current items are those expected to come due, both collected and owed within the longer of 1 year or the company's normal operating cycle. Okay? Now, most of the time, you could change this definition to current items are those expected to come due, both collected and owed within within 1 year, okay? Really, for your purposes, this is all I'm mainly concerned about. Current items are those expected to come due, both collected and owed within 1 year, okay? Now, with liabilities, this is pretty straightforward. If the liability is, you can come off the PowerPoint there. If the liability is due within the year, it is a current liability. If we pay it beyond 1 year, it is not current, okay? Let me give you some examples. Let's say I have a note payable to Peter, and I have a note payable to Brett as well. Well, if my note payable to Peter is I have to pay it off in 10 months, that's a current liability. If my note payable to Brett is due in 2 years, that's a long-term liability, okay? So you can't just see note payable and go, are notes payable current or non-current? Depends when they're due, okay? Also in regards to liabilities and whether they are current or non-current or not. Let's say that I have a mortgage payable on the office building, okay? And let's say that I owe $200,000 on that mortgage payable. Are you with me? For my office building. Well, let's say of that $200,000 that I owe, $10,000 is the amount that's due within the next year, and then $190,000 is what's due 1 year and out and after. Are you following this?
So you have a current liability?
Yes. So what you do is, even though this is one instrument, you strip away the current part that's due within the next year, and it is a current liability, and you take the long-term part and put it down in the long-term liabilities. You with me? Okay. The other thing that will always be, or most always be, for your purpose you can say always, will be current liabilities are your accrued liabilities. What are your accrued liabilities? Well, that harkens back to Chapter 3. These are going to be your AJE payables that you set up, such as income taxes payable, salaries payable, wages payable.
Prepaid insurance.
Yeah, but that's an asset. That's an asset. So if you have a interest payable, those are all due within the year, okay? So those are current liabilities. Accounts payable, is that a current liability? Yes, it's a current liability. Accounts payable is a current liability. And then there's another liability that's a current liability, unearned revenue. Okay? So in summary, what are your current liabilities? Accounts payable, unearned revenue, all your accrued liabilities, any notes payable that is due within 1 year or sooner, and any sort of current portion of long-term debt. Okay? Now here's something I guarantee will be on the test. Okay? For you guys and you guys. I'm going to list some accounts, and I want you to specify whether they are current or non-current. Okay? I'm going to list some assets and some liabilities, and all you have to do is specify, are these current or are these non-current? Because being able to properly designate these things as current or non-current is important for you in this class and beyond. Okay? That's a very important designation. So that's another thing that I guarantee you will be on the test. Make sense? Okay? All right, let's talk about the current assets. What are the current assets? Well, let's go to this example that is on the slide here. Current assets are those expected to be sold, collected, or used within a year. Okay? Now, with current assets, you almost have to, it's not as easy to just say, when do we pay it off, like you do the liabilities. So you have to do a little memorization here. Okay? These are your current assets. There's one that's not listed in here. I'll give it to you in a second. These are your current assets. Cash is a current asset. Short-term investments are a current asset. Accounts receivable is a current asset. Merchandise inventory is a current asset. That would be the things that, like if I'm Best Buy, all the merchandise that I have for sale, CDs, DVDs, all those sort of things. Those are a current asset. And then any of your prepaid expenses, your prepaid rent, your prepaid insurance, those are current assets. Okay? Yes, Erica. Okay.
Well, does revenue wouldn't be? Never mind.
Okay, that's
Revenue
fine.
is an asset.
Okay, two more things that are current assets besides the ones that I have circled here on the PowerPoint. Let's go to the PowerPoint. Supplies. Whoops, kind of sloppy. It's not easy to write with a mouse. Okay. Supplies, like office supplies or any sort of supplies, those are a current asset. Okay. All right. One more thing that I'm not going to write because it's too long is any sort of note receivable, if it is receivable within 1 year or less, is a current asset. Okay? So, again, let's say that Gil and Zach, I have a note receivable in regards to both of you. You have to pay me within 4 months. That's a current asset. You don't have to pay me for 1.5 years. That is not a current asset. Okay?
It wouldn't be, the portion of it wouldn't be?
Well, no, I'm going to make the assumption that they're going to pay me off in one lump sum. Okay? Okay. So, I won't get much more confusing beyond that, what I told you. Okay? I'm not going to throw something in weird for you. Okay? But let's talk about all the things that are, well, we can't be exhaustive, of course, but a lot of the things that are not current assets. Let's take a look at those below. Any sort of long-term investments are not current assets. They are long-term. Now, see how they said note receivable? I won't do that to you on a test, okay? Because you don't have enough information. It could be a 4-month note receivable, couldn't it? So I think they should specify when that's due. Investments in stocks and bonds, land held for future expansion. Those are not current assets. Some more things that are not current assets are your plant assets or your fixed assets. That means your store equipment, cars, automobiles, buildings, forklift, conveyor belt, whatever, office equipment. Those are not current assets. Okay? We will not fully reap the benefits of those things within 1 year or less. Okay? And then intangible assets, we'll talk about those more when we get to chapter 10, I believe. Those are things like patents and copyrights. Those are not current assets either. You with me? Now, looking at this balance sheet, you can see one of the important subtotals that we have here is current assets, okay? That helps us calculate the current ratio, which I think I had you read about as well, okay? All right, let's take a look at the other side of this balance sheet, the liabilities. Again, your current liabilities. There's AP, there's wages payable. I don't like that note payable. It's not specific enough, okay? But let's assume that's a note payable due in 6 months, okay? And then the current portion of the long-term liability. We talked about that, right? They also give an important subgrouping here called the current liabilities, okay? And then any sort of long-term liabilities, those are due that beyond 1 year, and your equity is not current either. It's considered non-current. We don't really classify equity as current and non-current, just liabilities and assets. Does that make sense? Okay, let's hop over to what the current ratio is. Okay, the current ratio is an important ratio. Okay, now some of these ratios that we go over at the end of the chapter, I don't test you on. This one, I promise I do. Okay? I promise you will be asked a test question on the current ratio. Okay? Because it's a very, very important ratio, one that you'll refer to in your business classes and in your accounting classes. The current ratio is simply current assets divided by current liabilities. This helps the company assess their ability to pay their debts in the short term. Okay? Now, I had a true-false question on a test once that about everybody got wrong, and here's what it said. It said something like, the current ratio, true or false, the current ratio helps, let's see what I said. The current ratio measures the profitability of a company. And that sounded so right, okay? But does the current ratio measure the profitability of a company? No. If I'm just looking at current assets and current liabilities, which is what the current ratio is, I have no idea what the net income is or what the revenues versus the expenses are. Nothing. Okay? So, the current ratio helps assess the company's ability to pay its debts in the near future. Let's say your current assets were $50,000 and your current liabilities were $100,000. Your current ratio would be what? No, it wouldn't be negative. It would just be 0.5. It'd be 50,000 divided by 100,000, which is 0.5. Is that a good situation? No. No, it isn't. Okay? Think about if you had $100,000 due within the next 12 months, and your current assets, not just your cash, but all your current assets were $50,000. That's not good. Okay? Kind of a rule of thumb is you like the current ratio to be at least 1.0. Okay? Now, of course, you need to take into account what industry you're in and those sort of things, those sort of issues when we deal with any of these ratios. But 1.0 is kind of a rule of thumb. Could your current ratio ever be too high? Or is bigger always better? I would say your current ratio could be too high. For instance, if let's say a company has a current ratio of 20.0. Well, as a stockholder, I would question And then maybe I looked at that current ratio and we just have a lot of cash. A lot of cash. Well, it's great to have cash. However,
Better to have investments.
you want to be investing in the future of the company, don't you? Ultimately, the goal is not to have a great current ratio. Ultimately, the goal is to maximize your profits, right? So if there's another company that's current ratio is lower because they have invested in a lot of long-term assets, maybe a more efficient factory or something like that, well, that might be the better route to go, right? It's kind of like, you guys are young people. I would say when you start working full-time, you don't want to put all your money in some sort of savings account that's going to earn 1% per year, do you? You want to invest it into something longer term, okay? Does this make sense? So you always have to use some common sense with these ratios. They are one of many measures. The current ratio is one of many measures to evaluate a company. It's not the end-all be-all, okay? It's not the end-all be-all. Just like I wouldn't evaluate a baseball player based on one statistic, would I? Okay? I wouldn't evaluate a baseball player based on just one ratio. I'd look at the whole body of his or her work. Okay? All right. Let's do this. Let's take a look at the... Is there any questions, first of all? Okay, let's take a look at the homework. I believe the first one I assigned was Quick Study 4.3. Is that right? So let's take a look at that. Quick Study 4.3. Okay, this is just a little matching deal, isn't it? For each of the following, select the letter that identifies the balance sheet category where the item typically would appear. Okay, accounts payable, where would it appear? It would appear in the current liabilities. Is that correct? Okay. All right, what about store equipment? Plant assets, C, right? Accounts or wages payable? Current liabilities. And what about cash? Current assets. Okay? So 1, 2, 3, and 4 are E, C, E, and A, respectively. Okay? What about land that's not currently used in operations? Long-term investments. It would not be a plant asset because it says it's not currently used in operations. Okay? What about notes payable due in 3 years? F, long-term liabilities. Accounts receivable is a current asset. And trademarks, intangible. So number 5, 6, 7, 8 are B, F, A, and D, respectively. Okay? All right. Questions? Okay, let's take a look at Quick Study 4.4. Compute Palmolive Company's current ratio using the following information. Okay? And they give us a bunch of stuff here. Obviously, what we need to do is first calculate what the current assets are and then what the current liabilities are, right? So let's take a look at the solution here. Okay? First of all, your current assets in this situation are your cash, your accounts receivable, office supplies, and prepaid insurance. You know, not every company is going to have every current asset, okay? But in this specific example, your total current assets are $31,300. What are your current liabilities? Current liabilities are your accounts payable, your unearned revenue. So those total up to $14,000, right?
I think the office supply is 2860.
Is it? Is there a misprint?
Yeah.
You are right there, Peter. Good job. Yeah, good job, my friend. And you know why that is? Do you know why that is, Peter? because I was looking at the outdated answer key. But thank you for bringing that up, or all the people at home would have said, "What is going on?" So let's look at this again. Does this look better? Okay, thank you so much, Peter. Quick study 4.4. Here's the real answer. Okay? Current assets are 31,360, and the current liabilities are 14. Okay? Does that check out with everybody now? Okay. And the current ratio thus is 2.24. Okay? Now, I don't know whether we can do any sort of interpretation on that, because I don't think they give us any competitors' numbers, or they don't give us any numbers for this company in the past, right? But it is above 1.0. Okay? So that's good. All right? Overall, I think it looks pretty healthy. You got hot cash, you got receivables, and those are going to be the most liquid of your current assets. Do you know what liquid means? Liquid means how close is it to cash? Okay? How close is it to cash? Cash is already cash, so it's extremely liquid. Accounts receivable is liquid too. A lot more liquid than like prepaid insurance. Okay? All right, any questions on Quick Study 3.3 or Quick Study 3.4? All right then, well, let's go to exercise 4.4, 4.5, 4.6, and 4.7. And this was a little bit of a good refresher, wasn't it? Because you had to prepare financial statements, is that correct? So let's take a look at that. I think the first thing that they wanted you to do was prepare the income statement and the statement of equity for Resource Trucking Company. Is that correct? Now, you should be able to do this for the test. Sometimes I put financial statements on the second test, sometimes I don't. But you certainly should be able to do it. Okay? Sometimes I just put one of the financial statements or something. But let's take a look at the income statement first. I'm not going to spend a whole lot of time on this because this should really be review. But the income statement, it's prepared properly, right? Or in good form. The name of the company, the name of the statement, and it's dated properly. Okay? And it shows our revenues, and it shows our expenses. And in this situation, we have a net income because the revenues are greater than the expenses. Correct? The next statement we prepare is the statement of equity. And that is down below. And this net income of 26,463 flows down there, doesn't it? Okay? So you take your beginning balance of capital, you add your net income, you subtract out your withdrawals. It looks like in this particular situation that the owner did not invest any additional assets during the month of December 31, 2009. Okay? Or during December, I should say. Okay, any questions on that income statement and equity? You should still be able to know how to do that. That should totally be review. Now, the next thing they want us to prepare is what? No, they want us to prepare a classified balance sheet from the adjusted trial balance, right? So they want us to do an adjusted balance sheet, or I'm sorry, a classified balance sheet. A classified balance sheet. And let's take a look at that. Okay, you can see that it's titled correctly. And there is the answer to that. This capital amount was the balance of capital, the ending balance of capital that we got from the statement of equity that we just did, right? Okay. All right. You can see that they gave you some important subtotals here of your current assets and your current liabilities, right? And we'll use those in just a minute. Okay? Yes, question.
In the classified balance sheet, do you have to have the total current assets and total plant assets?
Do you have to actually total these up, you mean? Yeah, I would say the question is can you just list them in their categories but still just have one total, right? I would definitely at least do a subtotal for current assets and for current liabilities. Okay? You know, you'll find different companies do different things. But I would at least have a subtotal of current assets and current liabilities, because that's an important number for readers. And that helps us calculate immediately the current ratio. Okay? Good question.
Is one of these going to be on the test?
Well, I don't know yet. It certainly could be. Okay? But, you know, and remember, when I tell you things that I guarantee you will be on the test, that doesn't mean if I don't say it, it can't be. But the things that I guarantee that will be on there, they'll be on there. Does that make sense? So sometimes I put this on there, sometimes I don't, depending on how I structure the rest of it. Okay? Okay, I think the next question is exercise 4.6. It wants us to compute the current ratio. And it wants us to interpret that, assuming that the industry average is 1.5. So what do? Well, we take our current assets of 26.3 and our current liabilities of 13.8 and put them in the current ratio equation, and we get a current ratio of 1.9. Okay? What does that mean? Is that true or false? This means that Resource Trucking Company is more profitable than its competitors.
No.
That's false. We're not talking about profitability here, are we?
No.
We're talking about the ability to pay its short-term debts in the near future. Okay? I would say they're in a little better position, liquidity-wise, right? Or in their ability to pay those short-term debt obligations. Okay? So that's a quite quick little interpretation there. And then the final homework problem I gave you was exercise 4.7, right? And they wanted us to calculate these and say which one is in the strongest position. Okay? So there are your answers there. That was a tough one. You had to plug all those into your calculator, didn't you? So check those to make sure that you calculated them correctly. Which of these companies appears to be in the strongest position liquidity-wise? Case 1. Okay? Now again, you want to make sure that they're not spending or they're not having too much money in current assets. Maybe they should put some of that into productive long-term assets. Okay? But we would have to dig into that a little deeper. We can't do that with the information that they gave us. Okay? Does that make sense? All right. I think we are done with the homework. Now, I want to do something here. I'm going to shift gears on you. What I want you to do is this is a little chapter 4 refresher. I want you to prepare closing entries and do a post-closing trial balance for this situation. For you folks at home, this example is in your blue student manual, okay? But what we're going to do is we're going to run that snazzy JCCC music, and I want to spend a few minutes here doing another example of closing entries and then doing a post-closing trial balance, okay? So let's go ahead and do that now. We ready? All right. Hey, we're back. You might not be quite done. For you folks at home, if you're not done, hey, just pause it and then push play when you are done. Okay? All right. Here are the first two closing entries for this situation. Did anybody else get those? Okay, good. Now, here's the question I always ask here. I always step back at this point and say, do we have a net income or a net loss situation? And what do we have? We have a net loss situation, okay? But let's go ahead before we do the third closing entry and do what I always recommend you to do. And that is a T account for income summary. Okay, income summary, we credited it for $6,000 in the first entry. In the second entry, we debited it for $6660, right? Oh, I need to move that up. Thank you. Okay. So, what is the balance? What's the balance at this point? Don't say negative 660. There are never, ever, ever negative numbers in a T account. So the way we reflect this is this has a balance of 660 on the debit side. Does that make sense? Now, what do you have to do to close this? What do you have to do? Our third entry is to close income summary. How do you do that? You credit it for 660, now it has a zero balance. And that's your third closing entry is right here. Now this should make sense. Again, we assessed earlier that we have a net loss situation, right? And capital is a credit balance, correct? And we are debiting it here. Wouldn't a net loss, in fact, decrease our capital? Okay? Now, I want to remind everybody of one thing. Journal entries will never, ever, never, 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 never have a negative sign in them. And I don't care whether you show it as a negative sign or parentheses or whatever. No negative numbers at all ever in a journal entry. Okay? Never a negative number in a journal entry. Okay? And then what's the final thing we do? We close out our withdrawals. All right? Did anybody get those 4 entries? Anybody get them? Good. Let's take a look at what the post-closing trial balance would thus look like. I just did this real quick, so somebody tell me if that is what they got as well. If they got it. Now that capital number, remember how we calculate that capital number. Okay? We have to take the beginning balance of capital, but then we have to post that third and fourth closing entry to it. Okay? So our ending balance of capital is $23,840. Can you see by this closing process how it's kind of a flushing all the effects of the period into the capital account? And then all those accounts, those temporary accounts, are zeroed out and ready to go again? Does that make sense? Okay, but I wanted to give you an example of a net loss situation. Now, what I always do is after the second closing entry, I step back and say, okay, we have a net loss here or net income here. If we have a net income, capital should be increased or credited. If we have a net loss, capital should be debited, decreased. Okay? All right, I want to take about 2 minutes and tell you, as a refresher, the things I guarantee you will be on the test. Is that something you'd be interested in? Okay? Once again, I guarantee you will have to make AJEs, adjusting journal entries, a la Chapter 3. I also guarantee you will have to do an accrued salary AJE problem. That's the type where we had the calendar, remember, where I drew the little calendar? I guarantee you'll have to do one of those. I guarantee you'll have to do some closing entries, just like we did. Maybe you'll do a post-closing trial balance, maybe you won't. I'm not going to guarantee that, but I guarantee you'll do closing entries. And let me say one thing real careful to everybody. Make sure you're shifted into the right gear. Am I asking for adjusting entries or closing entries? Every now and then I have a student who's shifted into the wrong gear, and I give them a closing entry problem like I just gave you, and they're trying to make AJEs. Oh no, don't do that. So pay specific attention. Am I asking for adjusting entries or closing entries? The other things I guarantee you will be on the test. Is this a permanent or is this a temporary account? Thus, permanent accounts are not closed. Temporary accounts are closed. That's like one of the first slides of Chapter 4. I'm also going to be asking you about, is this a current or a non-current asset or liability? Okay? And the final thing you should always know for any of my tests, you should always be able to prepare financial statements. I'm not guaranteeing you that will be on there. I haven't written it yet. But you should be able to do that. And the other thing that sometimes I like to put on there is I want to make sure you know your account balances. Okay? Do you remember that question we had on a previous test? It was like, indicate how to yield the indicated change. Do you do it with a debit or credit? Such as, how do you decrease equipment? What do? You credit it. How do you increase accounts receivable? You debit it. I should be able to ask you that, and you should be wanting me to ask you that, because those should be easy points. Because if you don't know how to answer those sort of questions by now, that's not good. Not good at all. Okay? Remember, the best way to study for my test is what? Get a blank piece of paper out and see if you can do the homework. Okay? And then there's other ways that we've discussed in previous lectures. Okay? For you folks at home, I will send you specific information about the test. And for you folks here, you know what to do. All right? Good luck, and we shall see you. We'll start Chapter 5 next time we are filming.